I'm interested in your point that there's only so much the government can do, because the government has been trying to, I'm looking at it from the outside, it looks like they're trying to make sure that if there's going to be pain, at least it's shared, so that the entire burden isn't carried by the homeowner. But banks seem very reluctant to look at a house that was bought for $200,000, that's now worth $140,000, and say to the homeowner, look, we know it's only worth $140,000, let's split the difference. Take some of the pain themselves because they loaned on a house that just couldn't sustain that price. There's a feeling that the homeowner should take the whole hit in a lot of circles.
You know, part of this is as well is, let's say the bank does take the hit, then they have to recognize that in capital. And the reality is there are probably hundreds of mid-sized regional banks today that are maybe not on accounting in a sense, but in a real sense insolvent because they have not recognized those losses. They recognize those losses, they have to go out and raise capital. So to some extent what you're seeing is, sadly, on the part of the regulators, a wink and a nod saying, well, I don't want to have to shut you down, because if you recognize those losses, I probably would have to shut you down. So I'm going to let you pretend that that mortgage is worth what you said it was. So to some extent, and we're also encouraging you that, okay, if I don't make you recognize that loss, then you don't make the homeowner recognize that loss. And we really saw that. I mean, one of the key characteristics of Japan's lost decade was pressure on the banks never to write down loans and never to collect on loans.
And when you say write down, you mean have it reflected on
true
their
value,
books,
yes.
the real value of a property that you once loaned a lot of money on. But the thing that's scary about all of this is that in many cases it looks like banks, rather than make a deal, would rather go to foreclosure and end up realizing even less on the house. So you sold it for $200, it's now worth $140. If it goes into foreclosure, it's eventually going to sell for $75 or $80, which means you lose even more money. And the person loses their house with all the effects that follow after. Often you end up with a trashed house.
You do, and part of the problem is what the bank is trying to do is manage the loans on a portfolio basis rather than an individual basis. And why that's important is that for everybody that calls you, you don't know who's really going to walk away and who can't pay. I mean, yes, if somebody's lost a job, you can look at these factors. But if you say, okay, I'm going to reprice everybody's house, then everybody who could pay would call, and then you'd have to take a lot more. And it really is. I mean, so I mean, really, the bank is looking at its aggregate losses, whereas you might on an individual loan, it might be the best outcome for the borrower and for the lender, but it's not easy to tell that exactly ahead of time, even to be the case after the time.
Well, 2 points I wanted to make related to the previous conversation. The mortgage-backed securities is also something that affects many more of us than just the banks, the regional banks, because many of us who are employed, who have 401k plans or 403b plans and have some sort of investment, you know, somehow our investment, our retirement funds are tied to the market, and there's mortgage-backed securities and their performance, you know, this is all tied, so it's a long food chain. So that's one point. The other point related to the mortgages, that in the bank's willingness, there is a real sense that banks are unwilling to do modifications. We, for more than 2 years at Center for Responsible Lending, have advocated that there needed to be principal write-downs, that the research shows that if you actually bring the consumer, the homeowner, close to equity, perhaps not to equity, perhaps not to 100% of loan to value, but if you bring them close enough to equity, they have an incentive because they can see the light at the end of the tunnel.
So that they're paying a mortgage that really reflects the value of their house.
Exactly.
But what about Mark's point that would put a lot of banks out of business?
That's what I'm saying. It's a very complicated situation. And so the industry, on the other hand, did a study, and they talk about moral hazard in providing incentives for people to walk away. The reality is that even if you can pay, and you are in a severely depressed market, people are in fact walking away.
Curtis,
and that is increasing more.
I have a point that we haven't really hit on in its contracts. One of the reasons why our economy, the U.S. economy, has been so dynamic over the course of our history is because we recognize the sanctity of a contract, and that's what I think is really behind all this. people have signed a contract with a bank saying that they would take a loan for this amount of money. Altering that after the fact sets a very dangerous precedent going forward. It can make it harder for people in the future to get loans for homes. So I think we have to take that into account. As much as we want to paint the banks as the bad guys, there is a real reason to stick to the sanctity of contracts.
Our Constitution is a contract, and it has been amended 27 times. So a contract can be amended for the well-being of all, if that's what it takes.
But if you stick to the letter of the contract and drive millions of people to the wall and end up with worthless houses, you're standing up for the principle, but I'm not sure you're doing yourself much good.
Right. Well, once again, short-term, you're putting off the short-term pain for longer-term gain. Future people who want to go buy homes now, the price is going to be higher, or the bank's going to be much more reluctant to loan to them because
Well, we're seeing that already.
Because we've had people walking away, or the contract changes afterwards.